Welcome to the deep dive. Today we're really getting into something critical for investors. Market timing. We're not talking guesswork here. Our mission is to, understand the mechanics. How do these major market tops and bottoms actually form?
Exactly. We've pulled together quite a bit of material, but the real core of this is the book Mastering Market Timing. That's by Tracy Knudsen and Richard Dickson from 2012.
Okay, yeah, let's unpack that one. Knudsen and Dickson, they've kind of synthesized the work of Richard Wyckoff and L.M. Lowry, two heavyweights in technical analysis.
hmm
We're going to look at how their combined method, plus some other tools, can sort of light up those moments when the market really shifts gears.
And the goal here, for you, the learner, is to pull out the really essential stuff. We want to give you those aha moments, Deepen your grasp of how markets turn without getting bogged down.
Practical insights.
Yeah, focusing on the practical side of things.
Okay, so before we dive straight into the peaks and troughs, we need the bigger picture, right? The difference between those long, multi-year trends and the shorter cycles within them.
Spot on. We're talking secular versus cyclical markets. Secular trends, bull or bear, they can last a decade, maybe more.
And the cyclical ones are the shorter ups and downs inside those bigger moves.
Precisely. And knowing how to time things becomes, well, particularly important in those long secular bear markets.
Why is that? Why is timing so critical then?
Well, think about it. If the main trend is down or just sideways for years, just buying and holding a broad market index, it might not get you very far. The book uses that example. The S&P 500 in 2010 was basically where it was in 2004.
Wow, 6 years.
6 years of going nowhere if you ignore dividends. So it really shows how even safe index investing can stall out, making market timing, potentially quite valuable.
And figure I point 2 in the book shows this, right? That 2011 secular bear market and how the market leaders changed completely.
Yeah, the old tech and telecom darlings were out. New leaders emerged.
Which can signal those big secular shifts itself, can it? Like the book mentions, moving from inflation plays to disinflation plays back around 82.
Exactly. Or moving away from tech towards energy and materials in the early 2000s bear, it's a rotation.
And it's not just sectors. Figure I.3 brings in PE ratios, price to earnings. How do they help spot these huge trends?
Yeah, PE ratios for a major index like the S&P 500 can give you clues. Generally, in a secular bear market, you see PE ratios contracting over time.
And they expand in a secular bull.
Typically, yes. So that big drop in PEs after 2000, the authors say that really reinforced the idea we were in a new long-term bear phase.
Okay, got the long-term context. Now let's zoom in. The methods Knudsen and Dickson used to spot the turning points. This gets us to the Wyckoff method.
Right, the Wyckoff method. It's built on 3 core laws, basically. First one, the law of supply and demand.
Which sounds simple, but people sometimes think, well, every trade has a buyer and seller, so isn't it always balanced?
But that misses the point. It's the intent, the aggressiveness of buyers versus sellers. That's what creates imbalance and moves prices.
Okay, so if sellers are really eager, willing to accept lower prices just to get out,
Then price goes down. Simple as that. When supply, the desire to sell, overwhelms demand, the desire to buy, prices fall.
yeah.
And vice versa.
So Wyckoff analysis looks at price and volume together to figure out which side is winning that battle.
Exactly. You need both price action and the volume behind it to gauge the true force.
Makes sense. Now, the book really stresses figuring out market tops. Why start with the peaks? Seems counterintuitive, maybe.
Well, the authors make a great point. Not losing money is often just as important, maybe more important than making it. Think about that 1966 to 1982 period. The Dow basically went sideways overall. There were big rallies, sure, but you had to avoid the big drops in between to actually come out ahead.
So job number 1 is preserving capital by spotting when the good times might be ending.
Precisely. Recognizing the top formation, they're not saying you'll nail the exact high day.
No, nobody can do that consistently.
Right. But you can learn to recognize the characteristics, the phases that usually show up as a bull market transitions into a bear.
And that final phase of the bull market, they call it the distribution phase.
Yes, distribution.
Okay, break that down. What's happened during distribution?
It's kind of fueled by, well, greed and excessive optimism, right? Everyone thinks the market can only go up. But behind the scenes, the strong hands, the smart money that bought low, they start quietly selling.
Selling to the weak hands.
Yeah.
The newcomers jumping in late near the top.
Exactly. The latecomers buy high, fueled by hype, while the informed investors are taking profits. It's a transfer of shares from strong, informed holders to weaker, less informed ones.
Like musical chairs. And the music's fading.
That's a good analogy. And there are clues. The first one the book mentions is preliminary supply, or PSY.
PSY, what's that signal?
It's that first sign that the strong upward momentum is hitting a wall. Demand is meeting significant selling pressure.
And what does it look like, price action-wise?
You might see rallies start making less progress, maybe on still decent volume. Suggests buying is being absorbed. Often, market breadth starts lagging to fewer stocks participating.
So the advanced decline line might not be confirming new highs.
Could be. And the PSY event itself often involves a pullback on noticeably heavy volume, maybe the biggest volume pullback you've seen in that whole uptrend.
Okay, so that heavy volume pullback during PSY, that's the first real sign of aggressive selling from those strong hands.
It can be, yeah. But it's tricky because to many people, it just looks like a normal dip, a buying opportunity.
Right. So how do you know it's potentially more serious than just a pause? What else are you looking for?
Good question. That's where another concept comes in, 90% days, developed by Paul Desmond at Lowry Research. These signal really strong imbalances.
90% days. What makes a day a 90% day? It's not just volume, is it?
No, it's crucial. It's both volume and points. So for a 90% upside day, upside volume has to be 90% or more of the total up plus down volume. And the points gained by advancing stocks have to be 90% or more of the total points gained plus lost.
Wow. Okay, so it's broad participation and high conviction volume.
Exactly. And a 90% downside day is just the mirror image. These aren't subtle shifts. They show real force in one direction across the market.
Got it. So these big conviction days add weight to the evidence. The book uses the 1975-76 market top as a case study, right?
Yeah.
Figure 2.4.
Yes, a great example. You had the sharp rally, then months of sideways trading, then a final spike up on really heavy volume in early 76. Classic blow-off look.
But there were warning signs underneath.
Definitely. The selling pressure index, which Lowry calculates to gauge selling intensity, it actually started rising even while prices were still inching higher. That's a red flag.
So selling was getting more aggressive under the surface, even with new price highs.
Yeah.
Interesting. What else?
Buying power, Lowry's measure of demand, started to pitch over. It weakened. It's like the upward thrust was fading.
The fuel was running low.
Yeah. And then in April 76, you got this period of churning sideways price action, but on high volume. That signals a real battle, supply eventually overpowering demand. The authors say that churning was a pretty clear warning sign of the rollover coming.
And the book briefly mentions other tops, too, 68, 69, 72, 73, 76 again, 80, 81, each different but similar underlying themes.
Right. Durations varied, specific signals might differ slightly, but that core principle of supply starting to overwhelm demand, often flagged by things like rising selling pressure or weakening buying power, that's the common thread.
Okay, that covers tops. Now, the flip side, market bottoms. How do those form? The book splits this too, starting with the panic and capitulation part.
Yeah, understanding tops helps preserve capital. Understanding bottoms helps you know when it might be time to get back in, or at least stop being aggressively bearish. Bear markets often end in two stages. First, panic selling, then later, accumulation. The very first glimmer of hope is often preliminary support, or PS.
PS, what does that look like?
Usually comes after a long, grinding decline. It's a noticeable rally, often sharp. It suggests some buyers are finally stepping in, testing the waters.
Might see a 90% upside day around then.
You could, yeah. A strong surge in demand after all that selling. That would be a positive sign.
Okay, the 1974-75 bottom is the case study here, figure 4.1. What went down then?
Well, you saw that preliminary support, but, the selling wasn't done. Another wave hit, buying power fell, selling pressure spiked up again, and crucially, this led to a cluster of 90% downside days in just a short span, intense.
Okay, that sounds like peak fear. Is that a selling climax, the SC?
That's exactly what it signals, a selling climax. It's that moment of just pure capitulation. Everyone who's remotely thinking of selling just throws in the towel. Extreme panic, huge volume, often wide price swings.
The final washout.
Pretty much. After that SC, you typically get an automatic reaction, or AR. That's a bounce, often sharp, driven by short covering and some early bargain hunters.
But the low might get tested again.
Often, yes. That's the secondary test, the ST. The market drifts back down towards the selling climax low. What you want to see is the market holding above that low, and ideally on much lighter volume than the SC.
Lighter volume suggesting the sell-in pressure is finally drying up.
Exactly. It's a sign the panic phase might be over. That heavy volume during the SC itself is key. It implies exhaustion.
And the book notes the 82 and 2002-03 bottoms also featured important 90% upside days, right? Signaling those shifts.
Yes, those sharp reversals, especially after a long decline, they're powerful signals that demand is suddenly waking up in a big way.
Okay, panic, capitulation, selling climax, test. What comes next? Part 2, accumulation and the eventual breakout.
Right. After the drama of the climax and the test, the market often settles into an accumulation phase. It might look boring on the surface, maybe trading sideways for a while, but this is when the real smart money, the strong hands who see value, start quietly buying shares, often while the news headlines are still terrible and sentiment is awful.
So fear is still hanging in the air, but informed buyers are seeing opportunity. The 1982 bottom, figure 5.1, shows this accumulation phase well.
It's a classic example. You see the PS, SC, AR, ST sequence we talked about. Then, importantly, you start seeing signs of strength SOS rallies. These show demand is building. Buyers are becoming more assertive.
SOS rallies? Okay. And what about that thing called a spring?
Ah, the spring. That's a classic Wyckoff feature. Price dips briefly below the low of the selling climax or the secondary test. Maybe scares everyone.
Shakes out the last remaining weak sellers.
Exactly. But then it quickly snaps back above that support level. It's a bear trap, essentially. A final clean out before the real move starts.
Sneaky. And after the spring, maybe a last point of support, LPS.
Often, yes. A final small pullback or consolidation near the top of the range before the big breakout. It's a last pause before takeoff.
And the takeoff itself, Wyckoff called it the jump across the creek.
Yeah, I love that term. It's that decisive move up, breaking out of the trading range, usually on expanding volume. That confirms the accumulation phase is over and a new uptrend is likely underway.
The 2002-2003 bottom in figure 5.5 had similar elements. Multiple 90% up days, maybe a shakeout instead of a spring.
Yes, similar structure. Selling climax, AR, ST, multiple big up days. And a shakeout, another term for a sharp drop designed to scare people out before the rally resumed. Then the SOS rally, LPS, and breakout.
So the key thing in bottoms is that shift from sellers being in control to buyers gradually taking over, with these specific events like SC, ST, springs, SOS, and breakouts marking the transition.
That's the essence of it. Volume and price action tell the story.
Now, Wyckoff and Lowry aren't the only tools in the box here. Knudsen and Dickson talk about the weight of evidence bringing in other things, like point and figure charts.
Right. Point and figure, or P&F, ties into Wyckoff's second law, cause and effect.
Cause and effect.
Yeah.
How do P&F charts show that?
P&F charts focus only on price changes, filtering out time and minor noise. The cause is the sideways consolidation, the trading range, represented by the width of the pattern on the P&F chart. Wyckoff found you could count the horizontal extent of this cause.
Count the columns in the P&F base.
Exactly, and use that count to project a potential price target for the subsequent move, up or down. That's the effect.
Interesting. So the longer the base, the bigger the potential move.
Generally, that's the idea.
Yeah.
But the book is careful here. These are guidelines, potential target zones, not precise predictions.
So don't bet the farm on the exact number. What might make the market miss or overshoot these P&F targets?
Oh, major news, sudden shifts in sentiment, unexpected economic data. Lots of things can intervene. The book shows examples for the 72-73 top and 74-75 bottom, where the targets worked reasonably well, but others where they weren't as accurate. It's a tool, not a magic wand.
Gotcha. Another tool. The NYSE advanced decline line. We touched on it briefly with tops. How does it fit overall?
The 80 line is all about market breadth. It's the cumulative total of advancing stocks minus declining stocks each day. Super simple, but powerful.
And its big warning sign is when it doesn't confirm new highs in the index, right? Negative divergence.
That's the classic use case for spotting tops. If the main index, say the S&P 500, is making a new high, but the 80 line isn't, it's lower than its previous peak, that's divergence.
Meaning fewer stocks are actually participating in that final push higher. The rally is narrowing, getting weaker underneath.
Precisely. It's like an army advancing, but fewer soldiers are joining the charge. The book uses the 2007 top as a key example of this divergence warning.
The canary in the coal mine starts coughing. Does it help at bottoms too?
It's less about divergence at bottoms, more about confirmation. Seeing the AD line stop falling, flatten out, and start rising alongside price provides confirmation that the market's internal health is improving. More stocks are starting to participate on the upside.
Okay. And the last indicator they bring in is the percentage of NYSE stocks above their 30-week moving average. What does that tell us?
This one's about breadth momentum. The 30-week moving average is a pretty standard long-term trend indicator. So this tells you what percentage of stocks are actually in longer-term uptrends themselves.
So in a healthy bull market, you'd expect this percentage to be high and rising along with the index.
Ideally, yes. And just like the AD line, if the index makes a new high but this percentage fails to, that negative divergence signals weakening momentum, a maturing rally.
And the flip side at bottoms.
At bottoms, you can get positive divergence. The index might make a new low, but maybe fewer stocks make new lows relative to their 30-week average. Or this percentage starts turning up even as the index is still struggling.
Suggesting underlying strength is starting to build before the main index turns.
Exactly. The book shows this positive divergence happening at the 1982 bottom and also mentions the 2002-03 and 2008-09 bottoms. It shows internal improvement.
Okay, so combining Wyckoff Lowry with P&F, AD lines, breadth momentum builds that weight of evidence.
That's the goal. No single indicator is perfect.
Now, the book has a specific section on the 2000-2001 market top, calling it a curious case. What was so weird about that one?
The main thing was how scattered the timing was for different industry sectors hitting their peaks. Unlike 2007, where many sectors topped around the same time, the 2000 top was really drawn out.
Like some tech peaked way early in 2000, but other parts of the market held up much longer.
Yeah, the peaks were spread over almost 3 years, according to their analysis. That made it really hard to call the top using just broad market timing because different segments were doing different things.
But even with that weirdness, the underlying Wyckoff Lowry analysis on the S&P 500 itself still showed warning signs.
It did. The book points to stalling rallies, volume picking up on declines, selling pressure rising, breadth weakening. The classic signs were there on the index level, even if the sector rotation was unusual.
So the core principles still applied, you just had to look closely.
Pretty much.
Okay, bringing it closer to the book's publication time, they looked at the bull market that started in 2009. They noted some strange things initially.
Yeah, right after the March 2009 low, the recovery in things like selling pressure contracting was unusually sluggish. It wasn't the immediate strong snapback you sometimes see.
Suggesting maybe a lack of deep conviction early on.
Yeah.
People were still shell-shocked from the crash.
Quite possibly. And they also saw something really weird. The market rallied strongly, but buying power actually dropped to new lows, and volume was contracting. That's not typical bull market behavior, especially early on.
Very unusual. But eventually things normalized.
Yes, by about August 2009, the analysis showed strengthening supply and demand characteristics along with better volume, confirming the bull market was likely for real.
And they used the framework to analyze later dips too, like the January 2010 correction, showing why it probably wasn't the end of the bull run.
Right. Selling pressure was still making new lows back then, suggesting sellers weren't getting aggressive yet. The advanced decline lines were still confirming the uptrend too.
And P&F targets were still way higher.
Yeah, the P&F projections suggested much more upside potential remained, arguing against Jan or April 2010 being major tops. It helps gauge the potential scale of the move.
Okay, so pulling this all together, what's the big takeaway? Market timing isn't a crystal ball, obviously.
No, absolutely not. It's about probabilities. It's about risk management. The authors stress that by studying these historical patterns, understanding supply and demand.
You equip yourself with tools.
Exactly. Tools to recognize when the odds might be shifting, when risk is increasing at a potential top, or when opportunity might be emerging near a bottom.
And these patterns, they're kind of fractal. They appear on smaller timeframes too, but are maybe more reliable for the big picture turns.
That's the idea. The principles apply across time frames, but the major tops and bottoms, formed over months or years, tend to exhibit these characteristics more clearly and reliably.
So the bottom line is, every market cycle is unique in its details.
Always unique details.
But understanding this interplay of supply and demand, using Wyckoff, Lowry, and these other confirming tools, gives you a framework, a way to navigate.
It's a crucial framework for understanding market trends and making more informed decisions. Absolutely.
So the key takeaway for you, the listener, really grasp these core ideas. Supply, demand, the phases like distribution and accumulation, the signals like PSY, SC, divergences, add tools like PNF and AD lines. It won't make you perfect, but it can give you a real edge in understanding the market's ebb and flow and managing your risk.
And maybe a final thought to leave you with, something to chew on. Based on everything we've discussed today, these historical patterns, this analytical approach, what signs might you start watching for in the current market? What might suggest the prevailing trend could be starting to shift? That's something we're thinking about and maybe exploring on your own.